Every first Friday of the month, the Bureau of Labor Statistics releases the Nonfarm Payrolls report. And this is really one of the most important pieces of data that Wall Street, retail, and the Federal Reserve looks at in order to understand what the economy might look like going forward. In this past May report, it showed that the economy added 172,000 jobs, and that number is well above what most analysts expected. And at face value, that sounds like great news. And in many ways, it really is. More people working is a positive thing. But the jobs report is not just about one number, and understanding what it actually means for you and your money requires looking beyond just that headline. Today, we're going to break down the May non-farm payrolls report in plain terms. What the data showed, how the bond market reacted, what happened with stocks, and what it all means for the Federal Reserve's interest rate decisions going forward. The goal of today's video is not to sound the alarm or to celebrate. It's just to simply understand what is happening and why it matters. So let's start with the report itself. So what did the May jobs report actually say? As I mentioned, the headline number was 172,000 new jobs being added, and that beat the consensus estimate by a meaningful amount, but it also came alongside a combined upward revision of 93,000 jobs in March and April. In other words, not only was May strong, but March and April were stronger than they were originally reported. And that's a notable detail that doesn't always get much attention, but it matters because it tells us that the labor market has been more resilient than the initial data suggested. At the same time, there are parts of the report that told a more complicated story. The unemployment rate held steady at 4.3%, which sounds low, and really in historical terms it is, but it's been stuck at that level for several months without any improvement. Long-term unemployment, meaning people out of work for 27 weeks or more, ticks higher on a year-over-year basis. And that's worth paying attention to, because long-term unemployment tends to be a lagging indicator of stress in the labor market itself. And so what this gives us is a jobs report that is strong in some areas, but quietly softening in others. The payroll numbers are healthy, but the quality and distribution of that employment is a lot more mixed than what many people are talking about. That nuance matters because it shapes how the Federal Reserve interprets that data and ultimately how they respond with interest rate policy. So you may be wondering why that strong jobs report caused a lot of turbulence in financial markets. So we have to understand what the relationship is between employment data and interest rate expectations. The Federal Reserve raises or lowers interest rates based on their dual mandate, and their dual mandate is controlled inflation with a target of 2%, as well as maximum employment. And so in basic sense, when inflation is high, they raise interest rates to slow the economy down, and when the labor market is weak, they lower rates to stimulate growth. For most of the past year, investors have been hoping that the Fed would continue cutting rates as they did at the end of last year. And this would lead to borrowing becoming cheaper, and that's generally good for stocks and other assets. Now, a stronger than expected jobs report complicates that expectation because it signals that the economy does not need stimulus right now, which reduces the urgency for the Fed to cut rates and actually gives them more reason to focus on the inflation side of their mandate. This is especially important because inflation has been running above their 2% target for years now. And this is exactly what happened on Friday. The moment that 172,000 number came out, alongside those upward revisions for March and April, it forced bond traders to reprice their interest rate expectations. The benchmark 10-year US Treasury yield surged, and it surged to 4.5% by the end of the trading day. More significantly, the bond market began pricing in the possibility of another rate hike later this year, rather than what many people were expecting with cuts. That's a meaningful shift from where expectations stood just a few weeks ago. The stock market had a brutal reaction to Friday's job report. The S&P 500 fell over 2.5%, which is its worst single-day decline going all the way back to last year. The Dow Jones Industrial Average shed nearly 700 points, and the tech-heavy Nasdaq fell over 4%. In order to understand why a strong jobs report caused stocks to sell off, it's important to realize how interest rates affect stock valuations. When rates rise, investors have an attractive and relatively low-risk alternative to stocks because they can earn more from simply holding government bonds. And this draws money out of equities. Higher rates also increase borrowing costs for companies, which can soften profit margins and reduce future earnings growth. Both of these factors push stock prices a lot lower on Friday. And this sell-off was really concentrated in technology stocks, which had been amongst the strongest performers going into the week. Nvidia fell over 6%, Broadcom dropped almost 8%, Micron slid 13%, and Meta also declined 5.5%. These companies are among the largest in the world by market value, and they carry enormous weight in the major indices, so when they fall, the whole market comes down with them. Part of what made the decline so sharp is that markets have spent the past several weeks rallying on the assumption that rate cuts were coming soon. When Friday's data challenged that assumption, investors who had positioned for a friendlier rate environment had a big reason to pull back. The sell-off was, in many ways, just a recalibration of expectations rather than a signal that something has fundamentally broken in the market. The Federal Reserve finds itself in a very difficult position right now, and that May jobs report made that position even harder. The Fed's dual mandate is to maintain price stability, meaning low inflation, and to promote maximum employment. Now, for the past couple of years, their primary focus has been bringing inflation down from its post-pandemic highs, and they did so by raising rates aggressively in 2022. But since then, core inflation, which strips out volatile prices like food and energy, remains above 3%. And this gap between its target of 2% means the inflation job is not fully done. And cutting rates prematurely risks allowing inflation to re-accelerate. At the same time, keeping rates elevated for too long creates its own risks. Higher rates puts pressure on banks. They make it harder for businesses to borrow and to invest. They squeeze consumers who carry debt. The longer rates stay high, the more these pressures build. And Friday's job report complicated the Fed's calculus by showing that the labor market is still relatively strong. Cutting rates into an economy adding 172,000 jobs a month, which is well above the pace needed to break even with population growth, would risk overstimulating an already resilient labor market and potentially pushing inflation even higher. But leaving rates where they are continues to put pressure on the parts of the economy that are most sensitive to borrowing costs. For now, in my opinion, the most likely outcome is that the Fed holds rates steady and waits for more data. Rate cuts later this year are not off the table completely, but they are far less certain than they were a week ago. And I think it'll be very interesting to hear the commentary from the Fed meeting later on this month. So let's take a step back away from Friday's market moves and think about what this means at a broader level. The May jobs report is just one data point in an ongoing story about how the US economy is navigating a period of elevated interest rates. The headline employment figure, it suggests that the economy remains fundamentally healthy, with people working, businesses hiring, and the labor market proving more durable than many people expected. Even though this is the case, there are real strains that are building beneath the surface. Consumers are carrying more debt than they did before the COVID pandemic, and the cost of servicing that debt has continued to rise. Mid-sized businesses are facing higher borrowing costs as they have to refinance debt that they originally got at much lower rates. For everyday investors, the key takeaways from this week are relatively straightforward. Interest rates are likely to stay higher for longer than markets had originally expected, and that has implications for bonds, stocks, mortgages, and any borrowing that you might be considering. The next major data points to watch will be the upcoming CPI print, which is expected this coming week, and any public remarks from Federal Reserve officials. These will give the clearest signals about where policy is headed and how markets are likely to respond. That is all that I have for you guys today. I hope you guys enjoyed today's video. Thank you all for watching. And I know that the relationship between economic data and future monetary policies can be very confusing. So I encourage you, if you have any questions, to leave them in the comments below, and I'll do my best to get them answered. Once again, thank you all for watching. Please subscribe to the channel. I've really appreciated all the support that you guys have been giving me on this new channel, and I'll see you in the next video. Have a good rest of your day.